Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're taking a look at the concepts of risk and reward in trading. Trading and risk are connected to the extent that you can't have one without the other, and this is something that professional traders and institutional investors spend much of their time thinking about and planning for. Risk and reward are two sides of the same coin. The role of the trader is to manage these opposing forces by minimizing risk while maximizing reward. Risk and reward move in ratio to each other. That is, as the level of one rises, then so does the level of the other, or at least it should. There should always be a symmetrical relationship between these two factors, or if you prefer, they should mirror each other. So, as a trader, if you take a greater risk, then you should expect to receive a greater reward. That's the theory at least, but it's one that doesn't always work in practice. The relationship between risk and reward can break down for several reasons, though the most common reason is our inability as traders to correctly assess the risk within a trade before we execute. You can calculate the risk in a trade by multiplying your trade size by the distance to your stop loss. That's the point at which you would close or cut the trade if it moves against you. This tells us what our theoretical loss would be, in the same way that the difference between our trade entry price and take profit levels multiplied by our trade size shows us our theoretical reward. However, these calculations say nothing about what the drivers or influences on the price of the instrument we've traded in will be. If you can't identify those catalysts for price change, then you aren't planning a trade at all. Instead, you're just having a punt on the market and will be incurring a large amount of unknown risk. In situations like this, ignorance is not bliss. Instead, it's a recipe for disaster and an almost surefire way to blow up your trading account. In these circumstances, you end up with an asymmetric or one-sided relationship between risk and reward. There is no mirror image here because there is no reasonable expectation of a reward when risks are so stacked against you. Yes, you may get lucky and make money. However, long-term success in the markets is rarely based on luck and almost always on good judgment and following a process every time you trade. This is exactly what Wall Street professionals and money managers do when they trade. Even if we have got a handle on what the catalysts for price change are, we still haven't identified all of the risks involved in a trade. That's because of two other factors. Firstly, known unknowns. These are things we know, we don't know, or can't be certain of. For example, we might like to buy a particular stock, but as retail traders, we can't know if there is a large sell order just around the corner, which will invalidate our idea and our position. All we can do is make a judgment on the trade using the evidence available to us. On top of that, we have to contend with unknown unknowns. These are risks that we are not even aware of, that we don't even know to exist. In fact, this statement is not quite correct. We know that these risks must be out there, but we have no way of knowing what they are. COVID-19 is the perfect example of such a risk. In the end, it all boils down to probabilities and distributions. There are expected outcomes and returns from investment into individual asset classes or markets. Those expected outcomes are based on what has happened before, as well as the laws of statistics. This basically tells us that 95% of all outcomes will fall within two standard deviations from the mean, or midpoint, within a set of outcomes. That pattern of distribution creates the famous bell curve. However, not everything obeys these standard laws, and one of the things that don't are the distribution of outcomes within financial markets. They have a very different profile to the bell curve in our chart. The curve that they make is flatter than the traditional bell curve, or standard distribution, and the ends of their curve kick up to form what are known as Fattails. Those Fattails are the kind of events that cause market crashes. They are statistically improbable, meant to occur once every million years or more. And yet, they do occur, and over the last decade, those kinds of events have cropped up often enough to mean that we can't ignore them when we trade. Because if we do, and one of these events happens, we can be pretty certain that our account, or a large portion of it, will be wiped out. That's why, as traders, we need to hope for the best, but plan for the worst, and manage our risk and exposures very carefully, remembering not to overtrade, not to put all our eggs into one basket, to diversify our positions, and wherever possible, to keep some cash on hand. Managing the risk you can see and the risks you can't can help to keep you in the market even if the worst should happen. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions.